Kinds of foreign exchange market. Introduction to the module. To be comfortable in the forex market, one must be familiar with price quotes, the kinds of transactions that are possible, and some of the instruments one is likely to use. In this module, we will explore in greater detail the spot market, the primary arena for novice traders. We will also present the forward market, the futures market, and introduce the options market. Spot market. Look at the Forex quotes page of any bank or Forex trading service provider. You will typically see the main currencies quoted using 5 digits. Also, you will see not one price for each currency pair, but 2. The pip. In the case of the British pounds, or United States dollars, or the euros or United States dollars, where the value of each currency in the pair is broadly on a par with the other, the quotes run to 4 decimal places. For example, British pounds or United States dollars equals 1.2525. Euros or United States dollars equals 1.1515. In the case of a currency pair like the United States dollars or Japanese yen, whose parity is vastly unequal, there are only 2 decimal places. For example, United States dollars or Japanese yen equals 107.50. In all cases, the final digit in the price quote is known as a pip, and is the smallest price change. In euros or United States dollars, 100 pips means 1 US cent and 5 pips means 0.05 of a cent. In United States dollars or Japanese yen, 100 pips means 1 yen and 5 pips means 0.05 of a yen. The spread. Market makers and brokers who quote dealing prices do not know whether the counterparty wants to buy or sell the base currency. So, they quote the prices for both possible transactions. A bid and an offer, for example, British pounds or United States dollars equals 1.2515 or 18. This price means the market maker is prepared to buy the base currency at 1.2515, the bid. Sell the base currency at 1.2518, the offer. The difference between the 2 prices, 3 pips, in this case, is known as the bid-offer spread. A market maker will have significant trading volumes over a day. It is feasible that in the same moment that one counterparty sells British pounds at the market maker's bid, another is buying British pounds at the offer. The spread is, therefore, the reward for providing liquidity. For traders, though, it is a transaction cost. A measure of a market's liquidity is the narrowness of the spread. Delivery. Forex trades become binding contracts with immediate effect. Yet, the currencies in the exchange are only delivered 2 working days later. The 2-day delay is a standard feature of what is known as the spot market. The delivery delay is a legacy feature from a time when money transfers genuinely needed 2 working days to move from bank to bank. Today, real-time bank transfers are almost instantaneous. For example, the European Central Bank's settlement system processes euro payments in less than 5 minutes. The forex market's settlement rules, however, have so far remained unchanged. The forward market. Unless otherwise agreed, forex trades are by default spot transactions. However, the counterparties can contract to deliver at any future date. An agreement to deliver on a date that is not spot requires what is known as a forward transaction. One defers spot delivery through borrowing and lending. For example, a trader who has contracted to deliver US dollars and receive euros on the spot date, but now wishes delivery to occur 1 month later, would borrow US dollars to settle the spot contract and repay the dollar loan 1 month later. Lend the euros received in the spot contract and recover the euro loan 1 month later. The trader would pay interest on the dollars borrowed, but receive interest on the euros lent. Hence, forward prices depend solely on the interest rate differential between currencies. A forward transaction can be an integral part of a spot trade, called forward outright. Or, as shown in the example above, it can be a completely separate transaction known as a swap. Futures market. All the currency transactions described so far are over-the-counter, OTC, deals. They are customized to meet the precise needs of the counterparties in terms of amounts and delivery dates. In the futures markets, traders deal in standardized currency contracts. These contracts have the following characteristics. Predetermined currency amount, usually $100,000. Fixed delivery date, usually one per month. Centralized trading exchange. Settlement via the exchange. Currency options. Options, whether in currencies or any other market, are a special kind of contract. They confer to the owner the right, but not the obligation, to enter into a transaction at a predetermined price and date. The price of an option is called the premium. Two types of options are traded over the counter and in the futures market. Call, an option to buy a currency at a predetermined price and date. Put, an option to sell a currency at a predetermined price and date. The absence of obligation is critical in understanding options. If the market price on the predetermined date, the expiry date, is unfavorable, the option holder will not exercise that right. For example, if the market price for the currency specified in the option contract, the strike price, is higher than the prevailing market rate, the holder of a call option will not exercise the option. It would be preferable to buy in the market. The option is effectively worthless. Delta. The strike price of the option relative to the underlying market price, as shown above, is a crucial component in the option premium. The degree to which the option's value changes, relative to any change in the underlying market, is called delta, the first derivative. If the market price is below the strike price of a call option, out of the money, the option is unlikely to be exercised. Even a modest increase in the price of the underlying might have only a negligible effect on the value of the option. The option premium, in this case, is not sensitive to changes in the market price. If, on the other hand, the market price is higher than the strike price of a call option, in the money, exercise at expiry is likely. If the market price is high enough, the value of the option will fully reflect each move in the underlying. In this case, the option premium is highly sensitive to changes in the market price. Gamma. The second derivative of an options premium is called gamma. It is the rate of change of its delta. This measure, like delta, is continuously changing. It is, however, likely to be at its peak when uncertainty about whether the option will be exercised or not is highest, that is, when the underlying market price is near the strike price, at the money. Vega. Vega measures the sensitivity of the option premium to changes in the volatility of the underlying market price. Typically, options are more expensive when the market volatility is high. Theta. Whether the underlying market price changes or not, time never stands still. Part of an option's value accrues to the time remaining until the expiry date. When that date is in the distant future, one lost day matters less than when expiry is imminent. Theta is a measure of this time decay. Delta, gamma, vega, and theta are collectively known as Greeks. Summary. Familiarity with price quotes, everyday terminology, and the most popular instruments is essential in the fast-moving forex markets. Profits and losses, bid-offer spreads, and price changes are often referred to in pips. The spot market captures changes in the relative value of two currencies. The forward market captures the interest rate differential between two currencies. The futures market is a standardized version of the over-the-counter interbank market. Options confer a right, but not an obligation, to their owners.